Good afternoon, everyone. I'm David Balin from Personal Wealth Strategies, and I want to thank you today for joining us as Justin Rice will explore with us the best strategies to eliminate student loans. We have a large turnout today, so just emphasizes the relevance of today's topic. Although many of the viewers in the meeting are familiar with Justin, it is my pleasure to formally introduce him to those who have not yet met him. Justin is a graduate of the Catholic University of America in Washington, D.C. There he majored in biomedical engineering. Justin then attended Rutgers University, where he obtained his master's degree. During graduate school, he began his studies in finance and earned his certificate in financial planning from Kaplan University. In March of 2015, he passed the demanding CFP certification examination, and after gaining valuable industry experience, earned the full CFP designation in September of 2018. In 2021, Justin earned the certificate in blockchain and digital assets from the RIA Digital Asset Council and New York Institute of Finance. He joins an exclusive group of financial advisors with the credentials to properly educate clients curious about this new and evolving technology. In 2019, Justin became the first person in the state of New Jersey and one of the very first in the entire United States to obtain the Certified Student Loan Professional, or CSLP designation, which allows him to help clients formulate the most efficient strategy to eliminate their student loans. He's a much sought after industry speaker presenting to several groups. Oftentimes, Justin is asked to present as an expert, teaching other financial professionals about student loans. Recently, Justin appeared as a featured speaker at the New Jersey chapter of the Financial Planning Association. Justin was born in Baltimore, Maryland, and currently resides in Cliffside Park, New Jersey with his wife, Susie. As if he didn't already have enough on his plate, Justin is the father of two 3-month-old twins. Here to help us demystify student loans and provide the strategies you need to know is Justin Rice. Justin?
Thanks so much, David, for that introduction. I look forward to diving into this topic that seems to be changing daily. We just had the announcement yesterday, kind of extending the pause, and we'll definitely talk about the implications of that. But before we dive into that, we'll just kind of go over a general agenda for today. And we'll do a brief overview of student loans and looking at the different types and why these aren't like every other debt and why they need to be viewed uniquely in terms of your overall financial plan. We'll take a quick look at the power of the income-driven repayment plans, looking at student loans under the CARES Act from March of 2020 and how things have evolved with student loans since then. We'll hit on public service loan forgiveness and the truth there. There's been a lot of misinformation published about public service loan forgiveness. And so I want to make sure to emphasize that the program does work. And then also specifically the PSLF limited waiver that came into effect in October of last year. And then also looking towards the end for options if you can't pursue public service loan forgiveness, you're not working in that nonprofit. So quickly, the types of student loans, there are really two main buckets, federal and private. If you have private student loans, they really do work like every other debt. You have a fixed payment most of the time, a fixed interest rate, could be a variable interest rate, but really you're going to have to eventually pay those loans off. Now, the federal loan program, as you can see, they may have a lot of different types of loans. Most of the often it's going to be those direct loans that are issued. Now, before 2010, if you went to school prior to 2010, you actually had the availability for a couple different types of loans as well, which we'll talk about how that's the key stumbling block for public service loan forgiveness is having federal loans, but the wrong type. And we can kind of talk about how to qualify them. Also, how federal loans are different is that there are actually two different types of even the direct loans. You have the subsidized and unsubsidized. So that's the subsidized, or exactly how it sounds. The interest is subsidized while you are still a student and in a period of deferment. And so you actually don't have to pay interest while you're in school. Those unsubsidized, it builds up the interest while you're in school. And then eventually that will capitalize into the principal balance when you start a repayment plan. So there's no type of subsidized loans in the private landscape. That's unique to federal loans as well. Now, when looking at federal loans, there's really two main ways to pay them back. And this is how they start to differ even further from private loans. So you do have balance-based repayments, which is how pretty much every other loan gets repaid. So if you think of your mortgage or a car loan, you have a fixed term. So let's say a 15-year mortgage, you know that it's going to be a level payment over those 15 years. And at the end, the loan is going to get paid off. And that's going to be based on the loan balance and the interest rate, the size of the payment. So they have that in student loans as well. So they've got level plans. The 10-year plan is the default program that you'll be put in. That's the standard repayment plan. There's also some other 25 and 30-year level periods. There's also graduated payment plans where it starts low and then increases over time, but it will be paid off after a fixed period. But the income-driven repayment plans is really where the federal loans are unique in that they have payments where it's not based off of the loan balance at all, not based off the interest rate. It's solely based on the current income of the borrower. And if you are going for public service loan forgiveness, the IDR plans, the income-driven repayment plans, are necessary in order to qualify and do that. So let's just take a look at some of the executive orders in the CARES Act that have come out and changes to student loans over the past 2 years that are really pertinent. So on March 27th, that's when the CARES Act was signed into law. So President Trump kind of came out on March 13th and said, we're going to pause student loan payments. And then the CARES Act came out and expanded that, saying, yes, we're going to pause it. Interest is also going to be paused as well. Initially, it was through September 30th of 2022, but we'll get to where it's extended now. But this was for federally held loans, which really means those direct loans that are held by the Department of Education. They're serviced through different private organizations, but the loans are actually owned by the Department of Education. And so those are the loans that were affected. Now, there's some of those older type of federal loans, those FFEL, Federal Family Education Loan Programs, that were federally held and qualified, but most FFEL loans and all private loans didn't qualify for any relief, and there's still no relief for them. So the initial was the March 13th through September 30th of 2020 with no interest or payments due on those federally held loans. That has now been extended, was May 1st now, and that was the final extension, but now it's extended again for maybe a final extension through August 31st of this year, and that's been via executive orders. The important part when it comes to forgiveness is that these months of zero payments count towards the public service loan forgiveness program, which is important. So now I'm going to dive into public service loan forgiveness, which is the main avenue for forgiveness of student loans. It's the most popular forgiveness program. And again, we're going back to this difference between direct and FFEL. So the public service loan forgiveness program is only available for direct loans, not those older type of FFEL loans. Now, if you have those FFEL loans, you can do what's called a direct consolidation to turn them into direct loans and have them qualify. But if you were just pursuing them based on the FFEL loan status, you can't. Now, to qualify for public service loan forgiveness, you have to make 120 on-time payments while on an income-driven repayment plan and while working for a qualifying nonprofit. So there's a lot of different boxes that you have to check in order to qualify for forgiveness. And unsurprisingly, since it was so complicated, a lot of people failed. This is also a tax-free forgiveness. So you do not owe any tax obligation on the amount that is forgiven. And like I just said, it has a very, very high failure rate due to that misinformation. So a lot of people had those older type of loans, the FFEL loans. They were on the wrong type of repayment plan. So they weren't on an income-driven repayment plan. They might have been on a graduated repayment plan. And so when the applications initially first started to come in for people that were initially first eligible after 10 years, it had a 99% failure rate. And the failure rate has continued to stay pretty high. I think it's gotten a little bit better. I think it's about 97% now. So what they did to address that really came down on October 6th last year via this PSLF limited waiver. And on October 6th, the U.S. Department of Education came out with changes to the PSLF program. And the key here, and why this is such a pertinent topic to talk about right now, is it's only for a limited time, meaning that there's action that you have to take in order to take advantage of the limited waiver if you want to pursue that. For the interest pause, that you didn't have to do anything. So it just automatically happened and you were able to take advantage of 0 payment, 0% interest. But for this public service loan forgiveness waiver, you have to take action to make sure that you qualify. So the authority for all of this activity on student loans that they've been able to do is really based on past legislation, the HEROES Act of 2003, that allows the president to take action when there's a national emergency to kind of change that public policy. And they're using COVID-19 as the national emergency, and that currently is extended through October of this year to give them the authority to change things. So when it comes to the payment pause, they've extended it to August. They can pretty safely extend it through October without running into any legal afoul. But assuming that the COVID-19 pandemic stays on the course that it is, and they kind of end the emergency in October as planned, and they don't extend that further, then their ability to change the loan program that like they have been over this time period also goes away from a legal standpoint as well. So they may try to extend it even further past that time period, and then just wait for it to go to the Supreme Court and get overturned if they wanted to continue to extend it. But really, October is that key time frame where they're going to run out of time to change it. So the key with the public service limited waiver is that you can receive credit for past periods of repayment that otherwise wouldn't have qualified for public service loan forgiveness. So what are those past periods? So looking at if you had FFEL loans, payments made towards them, they can bring in and count. Payments made on either direct or FFEL loans that were in a wrong type of repayment plan, as long as you were making a payment, those now count. So pretty much they removed all of the stipulations and made it basically, as long as you were working for a qualifying nonprofit governmental agency, 501c3, and you made a payment on your loan of any type of federal loan, any type of payment, then they will count those payments towards your 120 payments necessary for public service loan forgiveness. But here's the limited time piece of it. If you have those older type of loans, either the FFEL loans, the Perkins loans, or other non-direct federal student loans, you must consolidate them into a direct loan to have them included under this limited waiver. And the deadline to do that by is October 31st of 2022. So if you already have all direct loans, you don't have to worry about doing a consolidation. But if you have these older type of loans and want to bring them into the forefront to qualify for this limited waiver, then you do have to do that consolidation. Just one quick story about that. A client of ours, a physician, had these FFEL loans that were at a very, very low interest rate. He already had an easy payment plan with them. He would qualify for public service loan forgiveness if he had the direct type of loans. But by the time we would have done a consolidation without the limited waiver, it resets the clock. So anytime you do a consolidation of your loans, either direct or otherwise, that's the new starting period for public service loan forgiveness looking forward. This limited waiver pierces that consolidation and actually looks back behind it to see what loans you've paid on and how many payments that you had. So for this physician, he's already made well more than 120 payments towards his FFEL loans. And so under this limited waiver, we're processing a consolidation for him, and then submitting the public service loan forgiveness employment certification form to get his employment certified. And now he'll have over 6 figures of debt wiped out under this limited waiver. Otherwise, he would have had to just continue to pay on it. If he wasn't working with us and put his head in the sand, he would have missed this opportunity if it's after October 31st. So that's the importance of acting on this stuff. So then after you do that consolidation, you're going to want to submit that certification form to qualify your employment to make sure, yes, your employment qualifies. And then they will tell you how many qualifying payments that you have towards your 120 necessary for public service loan forgiveness. And one of the interesting things to look at is how much is this costing the government to have this pause on student loans? So it has estimated that the pause has cost the federal government more than $100 billion. And extending the pause costs about $4 to $5 billion per month. It's also really unknown how much the PSLF limited waiver is going to cost them, just because only a limited amount of people have started that process yet, as they still have it October to do it. Also, on the $100 billion and the $4 to $5 billion per month, that's just looking at interest. But when you go back and look at how the administrative forbearance and that pause on payments works, and the fact that it counts towards public service loan forgiveness, it's not only the interest that they're not getting, but it's that additional time, those additional payments that people otherwise would have had to be making on the student loans that they're not going to have to make. So they're really only paying, if it's a 2-year pause, for 8 years, paying into the loans. 2 years they didn't have to, and then that's going to get forgiven anyway. So that's not even factoring it in there. And so far, about 100,000 borrowers have been deemed eligible to receive the forgiveness based on the Public Service Loan Forgiveness Limited Waiver. That totals about $6.2 billion thus far. A website, studentloanplanner.com, which is a really great resource, they estimate that about over 2 million borrowers could potentially qualify for this public service loan forgiveness waiver, but many will probably miss out as action is required on their part. So really, we've been focusing in on the public service loan forgiveness, but I know a lot of people on the call aren't eligible for public service loan forgiveness. They're working in for a for-profit entity. They've got these federal student loans. What can they do about it? So depending on the debt to income ratio, you still actually may be eligible for a long-term forgiveness strategy in an income-driven repayment plan. So this really is if you have a very high debt to income ratio. So your student loan debt is 1.5 to 2 times or more your annual income. Then you can get on an income driven repayment plan, try to reduce the payments as much as possible, and then get the balance forgiven after 20 or 25 years. And that's depending on the income driven repayment plan. And one thing I'll mention about that as well is that the long-term forgiveness is actually taxable right now under current law, but under the American Rescue Plan for a limited period, it is tax-free, so only through 2025. But in Biden's recent budget proposal that he issued last week, he did have in there to extend the tax-free forgiveness of student loans even on the long-term forgiveness strategy. The other thing that you can do is to look towards other forgiveness or student loan assistance programs. So one example that I put up here is for a primary care physician or dentist working in an underserved area. So you can still be for profit, but as long as you're working in an underserved area, you could apply through this program and get up to $120,000 in repayment over a 2 to 4 year period, depending on that program. And I've actually compiled a catalog, which I'll talk about a little bit towards the end, that helps you identify some of these programs. Another thing that you can do, as long as the loans are still federal, is take advantage of income-driven repayment interest subsidies. And so with interest subsidies, and a lot of people don't know how they work. But for example, one of the income-driven repayment plans called Revised Pay As You Earn, that actually has a 50% interest subsidy on unpaid interest. So what does that mean? So if your income-driven repayment plan, so under Revised Pay As You Earn, it's 10% of your discretionary income. And so you're making that payment based on your income. That's irrespective of the loan balance or the interest that's accruing. So let's say your income-driven repayment plan comes to $100 a month. So $100 a month is $1,200 in a year. But let's say your interest is actually $2,400 in that year. So you're not even paying off the interest. So they'll take the $1,200 that you've paid through your income-driven repayment plan to pay down that interest. And if there was no interest subsidies, the full $1,200, the additional interest that you didn't pay, would accumulate onto that loan balance. But under Revised Pay As You Earn, 50% of that interest is forgiven. And so only $600 in that example would accrue towards your loan. So you have to look at more than just the interest rate in order to look at these income-driven repayment plans. And then the final thing that you can do is look to refinance the loan privately. That would be the goal of getting a lower interest rate, and current rates for high creditworthy borrowers are really, really good right now. We've seen an uptick like we have in a lot of other rates, but right now in the 3 to 4% range, depending on the length of the term, still very, very low historically, and probably rising quickly. So if that's something that is a potential, you do want to look towards refinance, especially now before interest rates continue to rise. So I just went through a lot, and I think, and there you go, rates are acting quickly, better act soon. So I thought it would be helpful to break all of that down into a flow chart where we can kind of go through. So again, we have those federal loans and private loans. Private loans are pretty easy, where the option is to refinance. So if you can get a better interest rate, better terms, you're going to want to look to refinance there. Under federal loans, you can really have those two different types. You've got the direct, you've got the FFEL. If you have the FFEL, it probably makes sense, or other type of federal loans, to consolidate them into a direct loan so that you're eligible for all of the potential programs, including the income-driven repayment plans, the public service loan forgiveness, all of that. Then once you have those direct loans, there's really two paths. Either you're working in a for-profit or you're working in a nonprofit. If you're working in a nonprofit, it really makes sense to go on that income-driven repayment plan, minimize the amount that you're paying out of pocket for the loans to eventually qualify for that public service loan forgiveness after 120 payments. If you're working in for-profit, it really depends on the amount of student loans that you have. So either you have a high debt to income ratio or a relative low debt to income ratio. If you do have that high debt to income ratio, you can still go on an income driven repayment plan, pay the lowest possible, and then eventually qualify for long-term forgiveness 20 or 25 years down the line. If you have a low debt to income ratio, again, you can try to take advantage of those subsidies if there is any, but eventually you may consider to actually refinance those to try to benefit, to get better terms, a lower interest rate. You do want to be very, very careful breaking that line of federal to private, because you do lose the benefits. So for example, those that refinance prior to March of 2020 didn't qualify for any of the relief that's come down from Congress, from the executive office. It's because they don't qualify. It's private loans. They only control the federal loan program. And there hasn't been relief for private borrowers. So you want to be very careful that before you consider a refinance from a federal loan into a private loan, but it does make sense in certain circumstances. So just to give some further resources here, definitely contact us if you'd like to see have a consultation, if any of these strategies will be right for you. That's my email right there, justin.rice@personalwealthstrategies.com, and our phone number there. And some other websites that would be helpful as well, studentaid.gov. That's the Department of Education website that really holds all of the information for your student loans. You do have access through your own servicer's website, but studentaid.gov is kind of the source there. And like I mentioned before, studentloanplanner.com is a great resource. And they also are really a really good place to look to refinance those loans. They offer really high cash bonuses for refinancing and really great rates. The one thing I do want to mention that I will circle back on is the loan forgiveness catalog that I put together. So in looking at the catalog, what I basically did here, and this was actually before 2020 that I put together. So some of the material may be dated, but I did want to get a resource out to you if you wanted it. And so it's looking at a bunch of different forgiveness programs, not only federal, but state specific as well. And then also employment specific as well. So you see there's teachers, lawyers, medical, dental, military, social workers, and my favorite is farmers. So there's actually a program in New York, if you're a young farmer, where you can get some student loans forgiven. I thought that was very interesting. So if you want this guide, and I'll put back our number here, what you can do is you can text our number 609-586-9308, and just text us the word guide, GUIDE, And there'll be a link there to fill out your information. We'll get this over to you via email, and you can go and research these different programs to see if you can qualify for any of them. So I'll just put back up our number here so you can have that, and then you can text the word guide to 609-586-9308, and we'll be able to get that out to you so you can look through that catalog and be able to see if there's other programs that can help you. So that's all I had. I'll throw it back over to David. I don't know if any questions came in on the line that we could take a look at, but otherwise I'll throw it back to David.
All right. Well, thank you, Justin. That was amazing. It was chock full of great information. And of course, as Justin offered, if you have questions specific to your personal situation, please reach out to us for a consultation. A recording of today's presentation will also be posted to our YouTube channel in about a week, so you can review the material presented. And I don't know about you, but I'm going to have to go back over some of this because there's a lot coming at you pretty quickly. Once that's posted, we'll send you an email to let you know that that video is ready for viewing. Please feel free to refer your family and friends to our YouTube channel for this and other presentations of view at your leisure. If you found today's presentation informative, please mark your calendar now to join us on the first Wednesday of every month. Our next presentation is going to be in May on the 4th. Again, it will be at the same time of 12 o'clock Eastern Daylight Time. Our guest presenter in May will be Jared Hoffman, who's a renowned expert on cybersecurity, and he'll be discussing the steps you can take to stay safe on the internet. Once again, I thank everyone for joining us today, and we'll look forward to answering any questions that you have through email and through consultations. Thanks.